Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, March 1st, 2019. Or we'll call this Video Friday. This is the third video today, probably be my last one, but I wanted to go over the 11 sectors in the S&P 500. That's something I do from time to time. I like to take a top-down approach to my analysis. First, look at the broad markets, and then drill down in there, look at the sectors that comprise the broad market. In other words, there's 11 of those in the S&P 500, and then further, then you can drill down if you find the most bullish or bearish sectors, and usually find the best-looking long or short setups within that sector. So this will just paint the picture for the bigger market and maybe explain to some. I've had a question yesterday. Somebody asked, Randy, what would change your view, make you abandon your bearish, longer term bearish outlook on the markets? And part of it is what I'll go through here in these charts. There's not any one thing, there's not any one level, but I'll show you what I'm seeing, and of course it's just my view and maybe right or wrong. So let's get into the charts. This to just start out, since we're looking at the S&P 500 again. Here's that level where it's really the top of where these first two rallies, almost that third rally, called almost a triple top of that trading range back last fall. That's where we hit on Monday, pulled back. We're still shy of that level now. And again, despite the resiliency of the market, that's all near-term stuff. Longer term, that's what we're going through right now. We're only going to look at daily and weekly time frames. So what I'll do is start out with the dailies. I'm not going through these in any particular order. In fact, it is worth noting, usually I have on each of these, I do have the weighting. If I don't make mention of the weightings down here. So this one's insignificant or not very significant as far as about a 3% weighting in the S&P 500. XLB. By the way, if you guys can't see my symbol mark, sometimes I get people that saying they don't see the videos clearly. I do record them in HD. I do 720 quality. I think that's good enough. Should be sharp enough on any monitor. But if your resolution's not good, usually you need to turn that up, or the brightness. But I tend to, I don't like the symbols to pop out too bright. It's kind of a visual distraction. But let me know if I get a bunch of feedback. Hey, Randy, I can't really see what symbol you're talking about. I'll turn this brightness up a little bit. All right, so XLB, that's basic materials, and a lot like, I mean, this almost mirrors the S&P 500. You have a very significant resistance level here around $56. Just like with the S&P, it capped, at least on this one, so you only have two reactions. The S&P had three. Remember, this is different. Each of these sectors, they can march to their own drumbeat at times. They are sectors within the S&P, so one way or another they will be impacted by inflows and outflows to the S&P 500 index funds, buying of the futures and all that, but they can at times go in different directions. So right now, all I can tell you with certainty is there was a very significant resistance level, not just from those two prior reactions back last fall, but that contained, for the most part, with a little momentum downside overshoot there, it contained all the pullbacks in 2018. It was also a resistance level broken, taken back, and tested their support. So what do we have now? We have a failure at resistance. And this is, what my expectation for the broad market remains at this time. We ran right into that resistance level, followed by 1, 2, 3, now 4 red candles, increasingly impulsive. That's what I want to see on the S&P 500. I'm not seeing that yet, but you can see these candles are getting larger and larger, and we're going lower and lower each day. When you start to see that on the S&P, it means the momentum has been broken, and then I think you'll get if we get it, the selling will continue to accelerate, at least initially, till you hit your first support level there. So there's basic materials. I'll wait to go through the weekly charts all at the end, so I'm just painting now more of the near-term, intermediate-term picture, and then the weekly charts, which I'll run through at the end, will paint the big picture. Next up, XLE, energy sector. Here's about a 5.5% weighting. This used to be a much heavier weighting in the S&P, but in recent years, tech has grown, whereas energy has shrunk. So you can see, similar to the S&P 500, just a nice level. I'm highlighting all the resistance back here. A lot of support, resistance, and support. Yeah, these are brief breaks, but you can see most of the candles, most of the trading normalized right there. We did slice through it a couple times here, but it did come into play again as resistance. And again, that's, call it not a hard line, but around 60, we'll call it $67 or so. And so far, that's where energy has failed. Ran up, crude also hit some resistance, and you can see we've been trending lower since. Not anything vicious, could just be a correction in time. I'll give it that. Could be flagging. I'll also give it that. Let's say that's really, I'll be honest, that's too long to be a bull flag pattern relative, because this would be your flagpole, and that flag is almost as long as a flagpole. That's technically not a, at least not a clean bull flag pattern, but it could still be the essence of that, which is a period of consolidation with minimal price give back followed by another thrust up. But as I like to say, until proven otherwise, resistance is resistance, and you're also overbought. So I don't see energy blasting on through and going up like it's not even there. If it does, maybe something else is going on in this market that I'm just not seeing right now, and that would be your next target up there around $70. All right, next up would be XLY, consumer discretionary. Here's a common theme you're going to see as I go through these sectors. This one's a little heavier now. We're talking about 10% weighting in the S&P 500. So this one does make a little bit of a bigger bite out of the S&P, or can help it depending which way it's going. So the common theme on a lot of these sectors that I'm seeing as I go through the charts today are we recently have bearish engulfing candlesticks. That big red candle, the body of that candle, if the body of the candle engulfs the body of the previous day's candle, that's a bearish engulfing. And that's bearish, particularly, again, this is important when using candlesticks, whether it's a single candlestick pattern or a multi-day candlestick pattern. You want to see them come at the right point in time. In other words, you get a bearish candle earlier in the middle of a trend, it's not going to mean a whole lot. Sometimes you close a day below or above. But when you have an extended uptrend and other technical indicators that are pointing to trend reversal, you look for a bearish reversal, and bearish candlestick, bearish engulfing candle, I should say, and that can often mark the end of a trend. So right now, in fact, it came at resistance. You can see the previous reaction here, some reactions back there, and we're still below it. These are things that I'm looking for. And for the bullish case, if the market powers up on through here, like it's, we had a little correction, just keeps going, clearly puts that in the rearview mirror, then it, like any other buy or sell signal in the market, that one didn't work. But right now, that is indicative of a potential top. We had the bearish candle. We closed down, next day not below it, but down, I should say right about where we closed it. And then 2 more down days so far. So today is somewhat of throws a little bit of a wrench. I will say that. And the whole scenario, I talked about it earlier with the S&P 500. I don't want to digress, but it is all kind of relevant. Talking about this near-term downtrend we had in the S&P 500 right here since Monday's highs, and everything was heading down, 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 and now we kind of popped up, and now we didn't take out the highs, but it sort of obscures or dilutes that kind of nice trend that we had. But as I often say, don't get tied up in the intraday noise. The day's not over. Let's see how we close today. Let's see that dump into the close. That's what I'm leaning towards and expecting, and if we see it, it will continue this trend of late day sell-offs, which is indicative of institutional selling, redemptions on funds and ETFs. That has been the trend all week, and today's not over. So let's just see what happens there. Next up, XLI. These are the industrials. Almost a 10% weighting, a little better than a 9% weighting in the S&P 500. What do you have here? Forget about all this. I haven't cleaned all these charts up. You can just see past notes. But the important thing here is you have a couple things. You have a trend line that comes off the lows. I like to, you had a melt, kind of let that undercut. You come in, this trend line right here captures the most number of bodies and or candlestick shadows, the skinny part. And that's how I like to draw trend lines. You have more reaction, 1, 2, 3, 4, 5, 6, 7, 8, and then a breakdown. And again, like a lot of things, mostly sideways consolidation. But we did break that trend. Like the S&P, you have the 50 still under the 200-day coming up right now to test it. And then you had, right now, I put a question mark because today is not over yet. You had a bearish engulfing candle. We have one in the works. But as I like to say, if I'm using a daily chart, all that really matters are the daily candlestick closes. So trend line break, little sideways trading followed by a bearish engulfing. Even if we get it today, I like to see more downside next week. Anytime I have a bearish engulfing candle or a bullish engulfing at the lows, I like to see follow through with additional red candles. You start moving lower from there. You don't want to take the top of the candle out. It sort of negates the whole bearish implications of it. XLV healthcare. This sector has grown in importance over the years, about 15% weighting. This is probably one of my messier boards. Just let's not focus on anything you see to the left of the chart. There's not even really a clean up trend line we can draw, and I really can't pick this one apart as far as bearish right now, but I do want to get to the weekly chart and show you that. Recent price action, we're just sort of, again, the momentum in the market's stalling out. Maybe, I'm not crazy about it because the head's not high enough, but maybe a little head and shoulders right here. That'd be your neckline, something to watch. You want to see us turn down almost immediately, or we go too high, we get up to the head, and you want to see impulsive selling back down to the neckline, and then of course an impulsive break below the neckline. Just one potential pattern. PPO is starting to roll over like the broad markets with a bearish cross there. Will it prove to be like these last few, or maybe just another whipsaw signal? We'll see. And XLK. We should probably spend a lot of time. I'll just go through the charts quickly, but as far as importance goes, the biggest sector in the S&P 500 by far, about 20% weighting. So 1/5 of what the S&P 500 does is attributed to what the tech stocks do. It is by far, it's much larger. It's about a 60% weighting in the NASDAQ 100. And as I said back here, I'll say it now. The market doesn't break until tech breaks. So you've got a uptrend line you can draw here. You draw it how you want, but you need to see some type of bearish price action, some breakdowns. We kind of limp through there. Nothing impulsive so far. And when you zoom back in, look at those candles. We really don't have anything. I'd be reaching for, straws, trying to make a bearish case out of anything I see right there. However, there is that recent consolidation period. We're very overbought. We're markets at resistance. So, really to undercut the recent lows, especially last Thursday's lows, should do the trick. Maybe a break out of this boxed range here. And again, looks like things are going to roll over, but it hasn't done so yet. So I did put out TVIX out there. I just wanted to get one thing out before the weekend. And I told you I'm still to get some confidence on those sell signals. I really want to see last Thursday's lows, not yesterday, get taken out. But again, I think the risk reward is worth it. I think to get in front of a trade that could potentially gap up 10% or more Monday or one day next week, and really maybe deny us a favorable entry. That's why I added that one on. So there's one to watch anyways. Again, until tech rolls over, starts moving down, you're not going to see the market do a whole lot to the downside. 50 still below the 200-day moving average. That puts the longer trend as bearish right now, despite this rally. That's one trend indicator, I should say. There's many out there, but that's one trend indicator that remains bearish at this point in time. Next up, there's only a few more. Oh, the other big one too is financials. This is another one that's really holding the market up right now. Almost a 14% weighting in the S&P 500. What do I spy with my little eye? I look at a very, very nice resistance level right here. You can see all these reactions back there, reactions there, reactions there. So I take that across that line. That was a big mess. Let me grab a solid line, not a box tool. And there was a little chopping through it in this volatility back here and here. But for the most part, I think that line has respected. Prices have respected that line with a few brief trips below or above. And again, it's worth noting. So I wouldn't give it a 10 on a 1 to 10, but I'd give it a pretty heavy enough weighting that it's significant. That's where financials kiss today. Nothing remotely close to a sell signal yet, but one to monitor. And again, it's like a checklist. You see, the more of these you see breakdown, there's a little minor trend line to watch. I'd have to look at the 60-minute charts. We're not going to go into the 60s here. We might have some divergence there on the 60, I'd imagine, and a little trend line break. And pullback target, if you're wondering, well, you have support here, but I think that'd get taken out. And I'd look for a swing target on XLF back down to here about 25.32 when this, if and when this breaks soon. XLC, this is the new, or relatively new communication sector. It replaced the old telecom sector. Just shows you how times are changing, about a 10% weighting. Here's another one of those nice, well, it's not super well defined, but it's worth noting, a little symmetrical triangle pattern. Those are indecision patterns. They can break either way. Respect whichever way it breaks. Doesn't mean you can't get a false breakout if it breaks up or down, but it just shows you prices are coiling. They're compressing, and you know, obviously, so bullish upside break, especially if it sticks, bullish, and downside break bearish. Can't really extract much more out of that. Here's a downtrend line. If it does break to the downside and we get a correction, you wonder how far it can go, even if we're still going higher. That would be a natural target. Price support plus downtrend line. That would take you down from here about 46.18 or so down to about 43.50 or so, and you'd want to maybe cover a little hair above that if you were looking to swing a short down or go long on a pullback. Other than that, I mean, there's some support before there, probably a little reaction here around 45. That'd be my first target to the downside. Upside, you know, if we break to the upside and this market power is much higher, they're probably just going to go to new highs. So you can, you know, I wouldn't try to eke out, you know, see the point, especially with the risk reward now favorable, trying to get a, you know, 2-3% trade. But that would be the next stop, probably about 47.77 in XLC. All right, XLRE. Here's another bearish engulfing. There it is. So again, very powerful, long, very extended, long in the tooth uptrend, followed by a recently put in a bearish engulfing candle, and like you want to see, nothing but for the most part. You don't have to have every day down, but so far we've been moving lower, which helps to validate that as a potential topping pattern. Topping stick. Again, sometimes maybe they're only good for a pullback trade, but quite often they can mark trend reversals. So, like I said a few days ago, I think it was Monday, yeah, when you get, or Tuesday, when you get a pattern like that. Actually, though, I'm sorry, back then I was talking about the island tops on the indexes. But same thing with a bearish engulfing. I trade it the same way. If I see it form that day, I'll either, you know, take a shot, take a short there, or wait till the next day, see if we trade down or the midpoint of the candle, just at a stop above. It's that easy. The risk reward is tremendous. You know, that's what trading's all about. You don't bat 1,000. You don't hit 100% of the shots you take. But if you can just take these small ones with, you know, small losses, you can get 3 or 4 of these wrong, and then you hit one right, and 5, 7, 10, 15, 20% or more. That's what it's all about right there. So I like these kind of patterns, and again, the point of this video is the S&P 500 or any index is simply a sum of its parts, and that's why I'm doing this video. So so far I'm getting some, you know, more check boxes on the you know, with sell signals than I am on you know, bullish things. There's still some that we don't have the check marks, but so far I'm showing you a few that I think do. XLP, consumer staples. This is about 7, a little over 7%. This looks more flagging to me. I have to give it that. Now it's also a defensive issue sector, which tends to do well in you know, or hold up better during you know, bear markets, recessions, when at least smart money people believe that the economy is slowing. So you have an impulsive move. You did have a bull flag right there, an impulsive move, which is you know, the flagpole or the move out, but it's also set up this flagging action, that potential bull flag, and if that one breaks out, we'd head up. Now, we do have a bearish crossover, and I will say this, even defensive issue stocks like utilities and staples tend to get washed out and pulled down during a strong market sell-off. So just food for thought. But you know, you have less, I think, you know, if you wanted to know which one, whether technology or this would have hold up better, if the market took a leg down, obviously this one should. I can't say obviously would, but it should hold up better. And again, it doesn't look bad. I can't really knock it hard from a technical perspective. Here's the 50 and 200. This one's above them. Does have the 50 coming up to test that. Actually, I should say that. Like a lot of things are above their 50 and 200. But it looks like it could cross. We've just whipped around really with the 50 and 200 here. Um, yeah, and let's move off this chart. These are the things, these overbought conditions, and everything else that make me not crazy about this one, but I just wanted to share my thoughts on it. Last but not least, utilities, and yes, you got it again, bearish engulfing candle. You have, let's zoom in a little bit so you can see it. There's your big bearish engulfing candle. Couple down days. We're still below the top of it. It's tried to make a run, but we haven't taken out the top of it yet. It also broke this uptrend line here, breakdown and back test of the trend line so far. So ideally, you don't always get what you want, but if this one's to play out for the bullish scenario, you want to see it, or bearish scenario, you want to see it stay above that top of that bearish engulfing candle, and you want to see it start to move lower now that it's back tested. And you also want to see a bearish PPO cross. Other than that, it's not going to make a big difference in what the S&P does because it's only about 3%. There is resistance right here. You had a previous reaction high. We're right around that level. This is where utilities have stalled out for the past couple of years. You can see that. You're not going to get rich quick off shorting utilities or going long unless you lever up. SDP, I believe, is it 2x, if I remember. It's been for ages since, ultra short utilities, SDP. So you're leveraging up, 200% on a sector that's relatively low volatility, no divergence because these have already taken out the previous lows. Plus, it's an index ETF or a leverage ETF chart, so I don't really put too much weighting on it. That's it. All right, guys. Now we'll do this a little faster. I talked quite a bit about what's on the dailies. Let's just run through the weekly charts in the same order we just went through. Starting with XLB, I'm going to flip over to weekly time frame. And here's the bigger picture to me on a lot of this stuff. And again, this helps formulate my outlook on the market. All right, so you can see trend lines, big trends. XLB has had its own series of bull and bear markets. You can call them corrections within an uptrend, but they're significant. Like, for example, back here, from high to low, XLB dropped 30+% from here. And you can see the year marks. This is a 10-year, by the way, these are 10-year weekly charts we're working off of going forward. There's a 33%. So there's certainly bear markets and bull markets to trade within this larger bull in this one. And again, it's a wash, rinse, repeat thing. When you take a bigger picture and stand back, look for these divergent highs. You can see on my divergence lines mark. That's where you usually the trend ends, then followed by a correction. Sometimes you get a divergent low, and if you do, especially in a bull market, great. That's a great time to go long and confirms a likely trend change. And again, you can see I have two alternative trend lines here. Both have been broken and back tested. Both of them were. And then we had this little minor trend line there. That was broken. No divergence at all. Actually, wrong. There was some RSI divergence right there on that push. But the way I see this going, and it could continue higher. Maybe that correction's over. Let's put it in perspective with the other two. I just showed you 30 and 33%, and about 27%. So on the low end, so is it possible that's all that we needed to satisfy that? Maybe. So we'll just watch. But what I think will happen is something like this. I think there's a good shot. We get another thrust down, maybe put in a divergent low at some point. If we can undercut those lows, come down here, I think there's nice support right around there, $46, $47. But again, you'd want to time your entries more off what you're seeing on the daily charts, but this helps formulate the bigger picture. All right, XLE, energy, again, 10-year chart, weekly chart, big, clean, divergent high. The bigger the divergent high, the bigger the correction typically. Very nice trend line. That was your sell signal. Look at that, look at that flagging action. See, that's what you want to see in a bull flag, or bear flag. Impulsive move down, nice bear flag, and then boom, break down out of the flagpole. And of course, there was a lot more to go. So there was a correction in the energy stocks. It was wiped out half the value, 51%. This is a similar type wedge. The divergence doesn't span as long, but Again, that's not always a one-to-one correlation with the size of the divergence. What I can say is it broke down. Nobody can argue that. There was a nice clean trend line. And the thing is, it looks like we've only had one wave down. I mean, even usually a corrective wave is at least an ABC. Here you had what probably, I'm not an Elliotician, but you could probably put on a primary five wave count, wave 3 being your most powerful, something along those lines. But so it just doesn't seem to me that I think this is just really a kickback rally in the markets in a lot of these sectors, and with more to come right now. But okay, that's what I think. What can I tell you? Well, the PPO is still solidly below the zero line. You guys know that's one of my favorite trend indicators, the 9 EMA, that is the fast line. Bearish trend, bearish trend, bearish trend, bearish trend. And you can see it works. These are weekly candles. This isn't just a few days. That's months. And this is probably a year or more right here. So this is saying by that trend indicator, markets on sell signal got ahead of itself, or the energy sector certainly got not ahead of itself. It was oversold. You don't want to keep shorting when you're that deeply oversold. Even during bearish trends, oversold readings will usually be followed by a bounce. But then you come back in, you have a bounce, then bounce runs its course, and you get oversold again. Bounce runs its course, you get oversold again. So that's where I think XLE is going. And next one, XLY. Oh, look at this chart. What a beauty. Look at this long-term chart here. Let's go to 6-day period. This goes back. There was, a little meltdown there in the 06 lows, 09, early 09 lows, but let's go back to a weekly chart. So you can see I've measured out all the divergent highs here. 21% drop, 11, 18, 17, 22. But more importantly, okay, so those were just corrections. You can call that a bear market if you want. It was simply just a correction in a larger bull market. But what makes this one different is the fact we just broke a decade-long primary bull market uptrend line that's, like I said, pretty darn well defined. A lot of reactions. Could be better, but more so right here is where it's really defined after 2016. And we're back testing. So I don't care if this was a 5-minute chart, 60-minute chart, a daily chart, and I don't care what security. When I see a breakdown after a divergent high, impulsive selling, and a back test, it back tested once, but right after. This is more of a typical back test, when you look at the scope of this pattern. Could it punch on through there? Absolutely. But, Trading 101 says, you either short a breakdown or you short or add to on the back test, and with a stop somewhat above. And trend indicators, below the zero line, the PPO signal line. I don't know, can't say much more to that. So it looks like chances are we'll get another leg down there. And if not, then the correction's over. We regain the trend line, and that's that. XLI, it gets a little harder. This is the best I can do on a trend line. A few reactions, enough to make it valid. It's not my favorite trend line, but there's a few. And here's one, see, that has taken it back on the weekly. So I'm going to give it points for that. I'm going to say, ideally, for the bearish scenario, two things. XLI, the industrial, should have stayed below 71.80. I think that was a very important support level right there. It was broken, back tested, and it should have stayed below that trend line. So these are the things, and I mentioned in the beginning of the video, what would really start to negate the bearish case? Well, that certainly doesn't help. That doesn't fit well with what should have happened in the technicals, both of those recoveries. However, trend indicator still bearish for now. It did hit support and bounced off there, but again, we'll just have to watch that. So what would help the bearish case for it to turn back down and lose that level again? Let's keep it very simple. It's regained it, already lost it once. It's a key level. Break it below 71.80 wouldn't be good. Otherwise, maybe it comes in a back test and then continues on to new highs and eventually puts this PPO back above the zero line there. XLV, healthcare. This one speaks a little more louder to me on the weekly chart. Here's jumped out 2009. Look at that nice uptrend line. Big old, we had a divergent high there with a 27% correction. There was a little flash crash in there to get to that number, to pad that number down to that low, but that was where it printed. I remember there was a flash crash back then on some securities and ETFs. And that's it. So let's zoom back to the weekly, get it a little tighter. We're just starting to creep above there. You can see here's some reaction. So I could pull that trend line up a little like this. You can play around with it. We're above it, but not close enough to say it's taken out. If I move the trend line up like this, exclude a few of those and come in and capture these, we're back testing. And again, big divergent high. From when I look at this pattern, this drop does not fit well or mesh with the size of those, the scope of those divergences, only a 15% drop, and the fact we're back testing. So it kind of funnels into what I'm seeing. We're really at a point where if the technical case that this was just a bear market rally is going to hold, we need to stop here and reverse soon on a lot of sectors and the market as well. Otherwise, look, does it mean we can't go back to have another big leg down if we go up another 5-10%? Doesn't mean that. It just would kind of muddle up the technical picture, at least the bearish case that I'm seeing here. XLK, tech, here's tech, long-term chart, again, 10-year, big divergent high. And again, time will tell. It's a bear market rally or not. All I can tell you is that we've only had one leg down. We've had an impulsive, almost an artificial looking ramp. Sometimes you see these low volume, these high frequency trading algos walk the market up. That's when you get the pretty big drops. I've seen them come before in other securities. That you don't see that, and then it just keeps continuing forever, and usually doesn't go sour. You get a correction. So tech, I think, is going to have a nice little correction here soon. Whether it's going to new highs or not, but again, it just doesn't. This doesn't fit. This fits, maybe this fits, but doesn't look sustainable to me. Is what I'm trying to say. XLF financials, they did grab. It's not a great trend line, but 1, 2, 3, 4 reactions, grab support. There's resistance right here, $27. Pretty significant resistance on XLF. If you look back here, the reactions, it's not a hard line, but around there. And, to really open the door for say with a high degree of confidence that bear markets, and you need to see this trend line as well as the others I just showed you. You need to see those get taken out on a solid weekly closing basis, and we're still a ways away from doing that. XLC Communications hasn't been around long enough to chart it on a weekly, so we'll have to skip it. I already showed you the daily. XLRE Real Estate on the weekly, big bearish engulfing on the weekly too. So there's that. It hasn't been around that long either. You want to use IYR, which is another REIT ETF that's been around longer. I'm just using XLRE because it is the Spiders ETF. That's the same. So the components in there are the same ones in the S&P 500. XLP, Consumer Staples, big nice uptrend line, rising wedge, breakdown, kickback rally, which so far has failed. Like most everything, we're still below. So far, this was the market top. And again, that's why you can argue all day long or debate whether this is a bear market rally or, just a correction. Until that's taken out, we'll see in a lot of sectors. So this one had big, nice bullish divergence on the weekly on both the RSI and PPO. And came down to oversold readings. I have a different level. I use 34.84 for my oversold readings on XLP because it usually hasn't hit that 30 level in over a decade. So that's why I have a different line there for oversold. And those were the arrows saying buy XLP when it's oversold at 35, 34. You can go long. It's worked. We almost hit it there. But so far, it's anybody's game. If we go down, this is a new downtrend. If we go up, it was just a correction. That's all I can tell you. And you can see my levels, key levels to watch. And of course, the break of the recent lows probably seal the deal. Finally, last but not least, XLU long-term chart. There it is, trend line off the lows. This looks pretty clear to me. This is a bull market uptrend line, a 10-year, decade-long bull market breakdown. Back testing from below, still below the trend line, right around the previous highs, potential double or triple top there. Divergences were in place at the time of the first correction when it broke and still are at this point in time. So looking at this through as an objective lens as I can, I think it's bearish. Billion-dollar question, was this correction enough to work off these divergences and everything else. And is this maybe going to prove to be a 1-2 year sideways corrective phase with utilities going higher? My money would be on a reversal here soon, but again, you have to use the daily charts to hone in on your entries there. All right, guys, that's it. That's all 11 sectors of the S&P on daily and weekly time frames, and from time to time, I'll continue to do an update on these. This has been Randy Finney with Right Side of the Chart. Have a great weekend.